Good morning and welcome to the Noble Capital Markets Virtual Equity Conference. I am Joe Gomes, Managing Director and Senior Analyst at Noble Capital. With us today for a fireside chat is Manny Hilario, President and CEO of the One Group Hospitality, and Tyler Loy, Chief Financial Officer. Good morning, Manny and Tyler, and thanks for taking the time to sit down with us.
Morning.
Thank you. Good morning.
So let's start with the big, broad, easy question. For those in the audience unfamiliar with the One Group, can you briefly describe what the company does, its key restaurant brands, and its key markets?
Thank you, Joe. Thanks for inviting us to the virtual meeting today. And the One Group, we're an international operator, owner and operator of restaurants. We currently own about 165, over approximately 165 venues. We operate restaurant brands such as Benihana, STK, Kona Grill, and Raw. And we also provide turnkey solutions for food and beverage at hotel properties. And we've been one of the faster growing restaurant companies for the last 4 or 5 years. And our plan is to, over the foreseeable future, to grow our company to be a $5 billion player in food and beverage. And we're growing both organically and through acquisitions. And we are known for vibe dining.
So let's follow up on that. The company describes itself as the leader in vibe dining. Can you describe what vibe dining is and why the company believes this is an attractive niche?
Sure. I mean, if you look at people's engagement with food, obviously, and beverage, there's obviously the fundamental, which is need to eat and need to drink, and that's the basic fundamental. Then there's the getaway, go out dining, where somebody really fits into the escape and experiential type of dining, where you go out to really have a very different and energetic and lively dining experience. Vibe dining really exists when what we consider to be the seven fundamentals of dining are performed at a very high level. Those seven fundamentals are high quality food, high quality beverage, fantastic environment and surroundings, great music, great ambiance, and great service. So it really, all those seven fundamentals are really critical to the success of vibe dining. And I think the way you always remember vibe dining is that once you go to one of the properties where vibe dining is being executed, you feel highly entertained. You feel like really enjoying the space. And what I always tell people is you can't wait until you come back and do it again. So really high level of experience, and it's really about surrounding all your senses with an exceptional experience.
So, kind of follow up on that, traditionally a lot of restaurants, one of the measurements, so to speak, is how quickly you can turn your tables. And it sounds like in vibe dining, you want the people to stay there for a longer time. Maybe you turn the tables over slower. So how do you square that with, continuing to generate the types of revenues that you would if you could turn the tables faster?
Very good question. So, our belief is that to execute a really well-rounded vibe dining experience, we think 90 minutes is the sweet spot. That's based on what we've learned from our customers, from talking to them and doing research on it. So we think the ideal time frame is around 90 minutes. If you think about other types of dining, usually around 75 minutes is kind of a standard. So slightly a little bit higher time, but also the offset of that is that the average check and what consumers are willing to pay for that experiential dining tends to be higher. So you're trading a little bit of 15 minutes on the turn times, and then getting a substantial advantage on what customers are willing to pay for it.
Thanks for that insight. Now, you mentioned, growth, some inorganic growth by M&A, and a little over a year ago, the One Group acquired Benihana and RA Sushi. How was the integration of the acquisition proceeding, and what have been the key benefits to date?
Yeah, I mean, I think that obviously acquisitions play a role in our growth and our chapter, but obviously our primary focus is on organic growth of the brands. For instance, our STK brand, we think that alone can be around 200 venues worldwide, which is a significant size brand. Our AUVs are around the $13-14 million range. So just on that brand alone, there's a significant amount of opportunity. So our earlier focus and our continued focus now is organic growth. We picked up the Benihana assets and the Ra Sushi assets because as we looked around vibe dining and the entertainment category, there was two clear players in that space. Obviously, STK was a leader in the vibe dining category, and then Benihana in the entertainment side. If you think of Benihana and the chefs and the showmanship of what happens in the restaurants clearly fit our vibe dining model. So, and then Ra also had a strong bar component, which the bar is really star component of vibe dining. It's really important to have an exciting bar program in vibe dining. So, with all that said, we felt that Benihana Ra was critical to our portfolio. As you look at our vision of being the undisputed leader in vibe dining, having iconic brands in our portfolio is critical. So there was a really nice fit into it. In terms of how we're doing now, a year plus out from the acquisition, we're doing very well. We've integrated the majority of the key parts of the business, meaning operations, supply chain, marketing, all the stuff that really makes the business tick. So we feel pretty good about those. The progress of the integration. I think we've mentioned when we acquired the company that we saw $20 million of synergies as a part of that integration of the company. We've already implemented a significant amount of those opportunities. So I think the integration and bringing the company in has been going really well. So I would say that we're frankly, based on our own internal timetables, a little bit ahead of what we thought we would be on the integration.
Okay. Now, you mentioned that you have a stated goal of 5 billion in system-wide sales, which is a significant increase from where the company is today. You also mentioned, growing the STK brand to 200 units. What else is the pathway to get to that 5 billion, and what is kind of the time frame you're looking at?
Yeah, Joe, that's a fantastic question. So in 2018, we established what we called the path to a billion, and that's early back then. It was my early days with the company, and we're barely over $100 million F&B company. So we were, a lot smaller than we are today. So we set up our path to a billion in 18, and that would have implied a 8-time type of growth for the company. So we achieved that frankly, in a reasonable amount of time. Within 6 years of establishing that goal, we were able to now grow the company to be over $1 billion in F&B sales. So again, once we've achieved our first path to a billion, now we're looking at 5, which is a 5x factor to growth. So it's actually, frankly, a little bit even less than what we established in our 18th ambitious goal pattern there. But again, that's our culture, is to establish goals and metrics for us to achieve over the long term. As I mentioned earlier, STK can be 200 venues globally. Benihana, we think it's 400 plus units domestically. So there's a tremendous amount of white space still available to us, both on STK and Benihana. And then, of course, acquisitions have always played a critical role in our overall growth. In 2019, we acquired Kona Grill, and then in 2024, we acquired Benihana. So again, it's a mix of both organic and strategic acquisitions that fit into our vision of being the global or the undisputable global leader in vibe dining. So it's really about setting those marks out there. But again, on the shorter term, our goals are more about integrating the current acquisition, and which we spoke about earlier, as well as focusing on organic growth. So that's our path. I think that we've done pretty well for the last 5-6 years, and this is just a continuation of our views of achieving long-term goals.
Now, you use a number of different, I'll call them ownership models. You've got company-owned locations, franchising, licensing, management contracts. All of those expect to help drive that growth we were just talking about. Where do you see the majority of the growth coming from in terms of the ownership? Uh, and how do you decide which ownership model to focus on?
I mean, I think as we look into the future, we've always seen an asset light model for the company, so a much larger proportion of our restaurants being owned by somebody else using our brand assets. So that's still our long-term plan. In the middle term, we did a little bit more growth through company-owned restaurants because one of the things that did happen with COVID is there was a significant amount of real estate that became available in markets that, frankly, real estate that we'd never seen available in a long time. So it was a great opportunity for us to accelerate getting to super high quality real estate in the short term through the company-owned model, but significantly long term, I see the company being mostly franchise, licensed, and management operations. And as I've mentioned in earlier calls, we've been actively now looking for partnerships and expanding also our franchise base. We already have an existing franchisee base who mostly have one restaurant, and we're now working with those franchisees already to try to create multiple unit opportunities with all of them. So you're going to see us significantly expanding our franchising and licensing capabilities to grow the brand. So if I looked long term and into the future, I think our overall portfolio will be more like 60% franchise licensed, managed, and maybe 40% company owned. So we certainly will skew a lot more towards the asset light of ownership.
Okay. And you briefly mentioned the company's food and beverage hospitality services business. Can you give us a little more detail about that business and how that fits into the overall growth plan?
Yeah, so it's a competitive advantage from the perspective that we use that business to actually get restaurants. That's actually our primary goal is usually to utilize our F&B capabilities to typically get an STK in a super high quality hotel. So it's actually, as I always think about it, more of a Trojan horse relative to getting STKs into hotel properties. And then from that evolves into us running room service and on the bigger hotels, if they have other restaurants and other venues in there, obviously we pick up the operation of that since the hotel operators typically like to deal with only one operator on their F&B. So it really is a way of us, frankly, getting more STKs is how I look at it, is a door opener to that business. So relatively speaking, the majority of the profit when we do an F&B deal comes with the operation of the main restaurant, which is usually or mostly STK. So that's how we look at that model. It's an opportunity for us. It's a strategic advantage in growing real estate, but per se, it's not a significant portion of our EBITDA growth or EBITDA portfolio.
Okay. And the margin profile of this segment, is that similar to the company owned and operated restaurants?
Yeah, I mean, I think on the hotel F&B side, the margins will be higher just because we don't pick a lot of the direct operating costs. Most of the costs associated with running those F&B operations are typically multi-unit leaders, which is already part of our G&A. So I would say the margin profile of that business is a better, but obviously the dollar EBITDA contributions usually comes from putting in a successful $10 million plus STK on those properties, which generates significant amount of cash flow both for the owner and for us.
Now, a potential growth avenue, which I think the company is exploring, is retail and CPG. Can you provide some additional color here?
Yeah, I mean, we've done historically business with Kraft on the frozen side with Benihana, so we're in the frozen on the in the freezers with that, and we're currently looking at expanding many of our businesses. Like sauces is a big opportunity for us. We're also looking at some other spice and some other food-oriented opportunities where we can utilize and leverage the name of the brand. So we're actively looking at that, and again, that's a great opportunity to drive royalties, drive licensing fees without having to put out capital. So I see that in the vein of asset light growth for the company, and stay tuned. We're actively looking at even at things like our pot stickers and our slider business. So there's a lot of products that some of the big manufacturers believe by putting our name on those products it will be beneficial for both them and us. So we're pursuing those, and you should be seeing us announce some deals here in the very near future.
Great. So, what does the capital structure look like, and will the company need to raise additional capital to finance its growth objectives?
Yeah, Joe. So we finished the first quarter with about 325 million of net debt. Additionally, we have a $40 million undrawn revolver. I think a key feature of the credit facility is that there's no financial covenant, so it's very flexible. It's very flexible from the company's perspective. Additionally, we have a preferred stock tranche that has a paid-in-kind dividend, and then we have the common stock as well. So, the nice thing is the business generates a lot of cash, and so our development targets and based on the cash generation of the business, we anticipate that the entirety of the growth will be can be self-funded. So I think we feel very good about our ability to self-fund the organic growth.
Any thoughts on debt reduction, or more of it just going to be for growth expansion, do you see?
Again,
Yeah,
oh, go ahead, Manny.
no, go ahead, Tyler.
No, I think that how we think about that is maintaining a lot of flexibility. So we typically never have more than 3 or 4 restaurants under construction at one point, never have more than a certain number of signed leases. And so I think that the pace of development is really within the company's control, along with the pace of allocating capital back to debt or putting cash on the balance sheet. So I think we have a tremendous amount of flexibility with that.
Yeah, the only thing I was going to add to that, Tyler, is that as we switch our emphasis on growth towards more asset-light opportunities, that obviously frees up more cash flow to work on the debt. So for the foreseeable future is that as soon as we get more into additional franchising deals and more license deals with our brands, that we will have more cash available to service our debt in the foreseeable future.
And you mentioned acquisitions as potential, padding to the growth. What types of concepts, obviously in the Vibe area, would the company be interested in?
Yeah, I mean, that's always a really good question. And when we look at acquisitions, we always look for the strategic angle and how it's additive to exactly what you just mentioned there. Does it fit our long-term objective of entertainment and vibe dining? And obviously, that's always a primary screen for us. So, said a little differently, the only type of assets or brands or anything that really fits our portfolio or our look into the future are things that are within what we do. So things that we do really well in operations, things that we do really well in marketing, things that do well in culinary, and then obviously fit into the vibe dining, experiential dining situation. So we're very disciplined about that. Right now, on the short term, we don't have any obvious acquisition targets or anything that we're looking at. Our primary focus, as we mentioned earlier, is to continue the integration of Benihana Raw, continue to work on the organic growth that we have in front of us, and just frankly, that's a lot more important for us in terms of of development. Also, as I mentioned earlier, asset light franchising, licensing opportunities. So that's really kind of on the shorter term where we're focused on. Obviously, we're always looking, and for us to be on our path to 5 billion, there will be always those quantum leap opportunities that we always look into. And again, it has to fit a very well-defined strategic path for us to go in it. So said a little different. We're not particularly saying, hey, we got to be an Italian, or we're not saying we have to be in Mexican, which are some of the more obvious categories that we don't participate in right now. We do think that being a multi-branded company is really important in the long term. We actually starting to see some of those benefits as we've rolled out our Friends with Benefits loyalty program. Having multiple brands in geography in close geographies allows you to leverage the multiple brands. Not everybody wants to go out and have the same cuisine every single weekend or every week. So having multiple brands allows you to go to an STK, go to a Benihana, go to a Kona Grill Raw, and really be part of that same program and earn points and be part of the loyalty program. So I think that having a diversified portfolio of brands creates that excitement for consumers. And we think it's a really long-term strategic advantage to be able to incorporate them into a one type of loyalty program for all those brands.
Okay. Now, there's been a lot of talk about the economic uncertainty recently, the tariffs on, the tariffs off, the Doge impacts. Has any of that had any impact on the company?
I mean, I think like everyone else in the country and the world, we have been subject to the variabilities that come with all the noise created in the macro environment by those situations. Obviously, some of these things are potentially real. Like for instance, we used to get shrimp from Vietnam. We had to switch to other areas of on the supply chain. So it has caused us to be thoughtful about supply chain and to also have a really a more thoughtful outlook into supply chain and really making sure that we're considering it. But I would say that in general, I can't really point out other than the one item that I just mentioned, something that is super significant on the business yet. And again, probably the bigger macro impact of that is tariffs on, tariffs off is what it does with the consumer mindset and how the consumer looks at all the news around those headlines. So it's mostly about that, more so than direct impact from those on the business model economics.
Okay. Now, what do you see as the biggest challenges for the one group going forward?
I mean, I think obviously the number one challenge always for growth company in restaurants is developing incredible high quality um, you know um, work employee base and creating um, um, if you will, the workforce that can take you to that bigger size. So our emphasis is always in creating a world-class team that can preserve the vibe dining experiences. So that's always our number one item of long-term emphasis. And then, of course, we're always, always looking at supply chain and the macro side of the business to macroeconomics. But from our management perspective, we spend a lot of time just making sure that we have a great workforce. And obviously now workforce also means bringing in the right levels of AI to complement what you're doing in your business. And then I would say last but not least is really technology, making sure that you're always bringing in the right technology at the right time, at the right cost. So that's the other thing that we always keep very clearly balancing and making sure that we're managing and preparing the company for the future.
Okay. And let's wrap up with this one, Manny. I'll put you on the spot. Give us your elevator pitch for an investor looking at the one group.
Elevator pitch, iconic brands, fantastic long-term outlook, lots of white space ahead of us, and frankly, one of the best leadership teams in the industry that can really drive some of the highest returns for all the iconic brands that we have. So really strong future for us.
Great. Well, Manny and Tyler, we covered a lot of ground today and got significant insight into what the One Group does, its markets, and opportunities. We appreciate you taking the time to do this fireside chat, and we wish you and the company the best in the future. Thanks again.